Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Here's the take from Monica DiCenso of JP Morgan Private Bank, writing, "We've been constructive on risk assets the last couple of years, and we remain cautiously optimistic. We believe the volatility, though, is back. Trade policy remains rightly the primary source of investor uncertainty." Monica joins us now for more. Monica, good morning.
Good morning.
How do you respond to the latest announcement?
It's very frustrating. It's very hard in my seat to try to predict what's going to happen, and that's what my job is, help people figure out the future and how to invest around that. And you just hear all this noise and just doesn't feel like Liberation Day is going to be Clarity Day. And so I think a week from now, we're still going to have a lot of questions. There will still be uncertainty. There will still be volatility. And so the most important thing for many people I work with is just diversify, have a plan, and get ready for more bumps.
You still see a path, though, for the S&P 500 to go to 6450 by the end of the year, that still is your base case at the high end of that range?
It is predicated on earnings growth, and this is the challenge. Like, what does this do to corporate spending, behavior, consumer behavior? We don't know yet. We had a really strong last quarter earnings. We'll see in a few weeks as we start to get through earnings again if this continues.
What do you make of Neil Kashkari's point that the uncertainty and the hit to consumer sentiment that we're seeing around the sort of on and off tariff announcements itself will be potentially more punitive to growth than even the tariffs themselves? At what point do you say, okay, this has gone on long enough that you can't make it up by providing some clarity on Liberation Day postponed?
Yeah, I think the next few weeks are going to be critical, because if we don't get any sort of calming around these headlines, I do think you start to worry about this seeping more permanently into consumer psyche, investor psyche. Right now, investors are saying, this might just be a negotiating tactic, it's noise, it's transitory, to use that tricky word. But the longer this goes on, the more I agree with him that this will have a permanent impact on people. Most clients I work with are still saying, I can deal with this, let's just wait out the next few weeks, and then I'll move, and then I'll decide what to do.
Just to add to Lisa's line of questioning, are we putting too much faith in the Fed's ability to respond to downside risk to growth with a potential inflationary spillover?
At this point, we still believe the Fed put is there, but again, there's just so many moving pieces, and I need to see. The most important thing for me in the equity call is how do earnings look. The other question then becomes one of valuation, because with this much uncertainty, is anyone willing to pay 20 times for U.S. earnings?
How much?
And I think that's the concern. It could be 18 or 17, and then suddenly you're down 15%.
We'll just pick up on that, the valuation point. How much of this story have we already discounted in the U.S.?
I think we've discounted what we see right now, which is the chaos, right? So you've had valuations come in. But again, if this is more persistent, if this continues into the summer, then I think there's a real question about, is 20 times the right number? And that's what our valuation is predicated on, that kind of multiple. You have to start questioning that if we're still grappling with these kind of headlines come May and June.
At the end of last year, people were questioning valuations on a bond yield basis, saying if bond yields continue to remain sticky or go higher, then it starts to raise the risk reward in going from bonds to stocks. At this point, what you're seeing is that bonds on a day like yesterday actually lost value. Yields rose. And it goes to the question of toggling between inflation and growth. At what point does that become a hampering factor to valuations as well?
I think it is. I think that's sort of what you're already starting to see. And the big risk, again, outside of earnings, is one of growth. And we are trying to put pencils around what does this look like from a tariff standpoint? How does that impact growth? And in a year when we're talking about kind of 2% real GDP growth, this could be significant if these are permanent, if they are broader, if you see retaliations from counterparts around the world. And that's just a little bit scary, because 2% growth is one thing, 1% is very different. And then again, what does that spillover do to earnings and everything else?
At that point, what does diversification mean?
For years, equities were the game in town, right? It was all growth, rates were low, you had the AI tailwind, and by the way, that still exists. But the challenge then becomes people are probably still too far over their skis in broad risk assets, probably too focused on the US. I still have a lot of people who have too much probably private exposure. There haven't been a lot of exits. And so I'm seeing a lot of risk in one bucket. We've been really advocating move into some safer parts, move into fixed income. I continue to get a ton of calls on gold. Gold was up 28% last year. People still want to buy more because they're saying, how do I diversify outside the U.S.? How do I have something that's a buffer in my portfolio? And lastly, hedge funds, looking for uncorrelated returns. I couldn't get anyone to talk about hedge funds for years. Now they want to talk about hedge funds again. So it's what's interesting. So what's old is new. Like this playbook became very boring for a while. Now you have all the tools again to play.
Yeah, and you've seen some spillover to places like Europe, even China as well. Equity markets there have started to pick up. Do you think maybe we're whistling past the graveyard in places like Europe?
Just saying Europe is cheap is a dangerous game, but there are certainly pockets where I think there's opportunity. And so even in the U.S., this has become a stock picker's market. So I would argue the same thing in Europe. We still are constructive on Japan. There's still, a valuation story there. You have reform still continuing. So I think you should be looking more outside of the U.S. Again, most of my clients are still heavily weighted to the U.S. from an equity perspective. Also on the fixed income side, we're looking at EM credit to try to get diversification outside of U.S. dollar.
Lisa, European equities down today. We're down 0.5% on the DAX, but that's where the outperformance has been over the previous few months.
Yeah, but to your point, the reason why the DAX is down is in part because German auto manufacturers are going to be very hard hit by some of these 25% tariffs, and they're going to have to really shift some of their supply chains considering how much of their business is done in the United States. Have we fully priced the hit to the rest of the world from tariffs implemented in the United States?
And this is the argument that Michael Hunt of Bank of America made on Friday going into the weekend, that the sell-off that we've seen in US equities was more about DeepSeek and Doge than it was about tariffs. That for him and many others too, we haven't seen the tariff trade really realized just yet.
And we don't really have a full understanding of what the tariff trade really means because it's got a lot of hair on it right now with the uncertainty as well as some of the tit for tat and what negotiations there are. I remember when this week was supposed to be negotiation week and suddenly now is something else.
It was. The Europeans were here. The Mexicans were here.
I know.
People were hopeful and here we are. Monica, it's good to see you. Thanks for dropping by. Monica DiCenso there of JP Morgan Private Bank. Don Schneider of Piper Sandler writing, the announcement of the 25% tariff on autos today shows Trump is eager to get on with the broader trade agenda. Auto tariffs are a core part of the industrial policy and revenue agenda. Much more to come. Don joins us now for more. Don, how much more to come over the next week or so?
I think a meaningful amount is coming, even if it's not over the next week. I mean, what we've seen so far is about 0.5% of GDP in tariff revenue. That's been announced. We have now the highest effective tariff rate since the 1940s when you add up the 20% tariffs on China, 25% on steel and aluminum and derivative products, 25% on autos, and then reciprocal tariffs are forthcoming. I think we've heard those are going to be dialed back considerably. But it's important to keep in mind that we have all of the product-specific tariffs that are still coming, whether it ranges from pharmaceuticals, semiconductors, copper, lumber. So there's much more to come.
Don, we've seen this movie before, only a month ago. Auto tariffs, Canada, Mexico. And then we found out they were exempt under USMCA. And I was watching that news conference yesterday, desperately waiting for a journalist to ask the question. The question never came. Have we got a decent understanding of whether those auto exports from those countries to the United States are exempt under USMCA?
It sounds like a portion of them will be the value added that's attributable to U.S. Production. If it's still coming from Canada, Mexico, will be exempt. It takes time to implement that. My sense is, at least I group things into kind of 4 different buckets. China is its own trade war. Canada and Mexico is another. Product-specific tariffs is another. And then finally, reciprocal tariffs. I think in the case of Canada and Mexico, Trump's end goal, I think, is to rewrite the USMCA on much more favorable terms to the U.S., and he's in particular fixated on auto production. So, just like what happened previously, you had 25% tariffs on Canada and Mexico that then said, well, it's only going to be 25% on non-USMCA compliant goods. Maybe that ends up being something like 30% of all goods end up being tariffed under those rates. I think that's still, a bargaining chip going forward that eventually those can either roll off and be replaced by reciprocal tariffs or by a rewrite of USMCA.
Don, do you think there's still room for negotiation, given that President Trump said yesterday about the tariffs on autos in particular, this is permanent 100%?
I think, there's 2 objectives. One is use tariffs to achieve non-trade concessions, and they can range, a lot of different things. You see from fentanyl, illegal immigration, whether it's digital service taxes, even the acquisition of TikTok. But then the other is true revenue and industrial policy. And I think anytime Trump is threatening tariffs on a product, there really isn't much negotiation to be had. He's saying, clearly, this is a critical industry. We can't be reliant on others for it. We have to make it in the U.S. So I think in the case of product tariffs, there aren't really going to be any exemptions, or there's no real negotiations either.
I'm glad you went there, Don. Yesterday, there was also this from President Trump. I view it as reducing taxes and also reducing debt, talking about the tariffs and the revenue from them. Within a fairly short period of time, I think we're going to have a balance sheet that's going to be outstanding. From a practical point of view, Don, how much could revenue from tariffs head toward offsetting the deficit that is set to potentially climb by $3 trillion over the next decade?
Here's how I think about it. Last year, we had a 6.5% of GDP deficit. 6.4 of that is our primary deficit, excluding interest costs. The interest costs are 3.1%. If all we did was extend the 2017 tax cuts, by the end of Trump's term, we'd have that 7.5% of GDP deficit. So there's structural upward pressure on spending from entitlements while revenues stay flat as a share of GDP and interest costs continue to grow. What he's announced so far is basically 0.5% of GDP in tariffs that may go up to maybe 70 basis points, maybe higher. That will subtract for growth, basically 1 for 1. So you will reduce economic growth. His tax and economic package, which will include spending increases on defense, border security, spending cuts on things like Medicaid, and then tax cuts, I think leaves us with roughly a 6.5% of GDP deficit, and then tariffs give us a little downside from there. So we're kind of getting pulled maybe closer to 6% if there's not that big of a growth hit. So I don't think this fundamentally changes the trajectory of the deficit. We're going to muddle along in this kind of 6% of GDP deficit, area for the next couple of years.
Does it give more breathing room, Don, to some of the Republican representatives who've been pushing back against some of the proposals and some of the debt ceiling extension and raising the debt ceiling on concerns about an expanding deficit? I mean, can they point to some of the revenue that was being raised by tariffs as an offset to justify their vote?
I don't think so. I mean, of course you could. I think the people who are most concerned about the deficit, say Freedom Caucus members, what they're really concerned about is spending. They want spending cuts, and they're not necessarily going to be placated by tariff revenues. Or likewise, consider Rand Paul in the Senate, libertarian. He doesn't want to vote for a debt limit increase, et cetera, and he doesn't like tariffs. So I think for the members that it really is important to help, who are most concerned about the deficit, tariff revenue doesn't really help. And I'd say secondarily, if we are using tariffs as a tool to bring, onshoring and production back to the U.S., generating a lot of revenue from that would be suggestive of us not onshoring that production and continuing to buy it from overseas. So if they truly do work, they wouldn't generate a lot of revenue.
Hey, Don, appreciate the update and your reaction to the announcement yesterday afternoon. Don Schneider there of Piper Sandler. President Trump's executive order sending shares of GM, Ford and Stellantis lower this morning. Ives of Wedbush writing, in our view, these initial tariffs, if they hold in their current form, would be a hurricane-like headwind to foreign and many U.S. automakers and ultimately push the average price of cars up 5K to 10K. Dan joins us now for more. Dan, welcome to the program. Let's just start with the basics from the top. Who's most exposed in the United States?
Well, I mean, Ford, GM, Stellantis, right? I mean, I think part of the problem there is that even if you make it in the U.S., I mean, you're talking a lot of times 40, 50% of parts could be from outside the United States. And I think you have 30,000 parts in a typical vehicle. So I think that's what, when it comes to Detroit, I mean, this is a gut punch to the 313 if this actually holds in this form.
Let's assume it holds. Dan, where does it leave Tesla? Let's do some single name work. What does it mean for them?
Well, even though their cars are built in U.S. in terms of Texas and California, when it comes to parts, I mean, you still have a good amount of parts that come from outside the U.S. And I think that's what Musk talks about. And in terms of downstream, no one is unexposed when it comes down to this. You have half the cars that have been imported into the U.S. 2024 are imported from outside the U.S. But the ones that are made in U.S., they still, I mean, you have 40% of engines that are basically essentially have parts built from Japan and Korea. And that's why what I could tell you is talking to many in Detroit last night, Europe overnight, I mean, the view is this is almost, I'll say, a non-starter. It would be a backbreaker for the auto industry globally.
What you see right now is some estimates talking about 40% of total operating profits for Hyundai and Kia combined, for example, is one kind of hit that some auto manufacturers would be taking. If this were the final negotiation, if we took President Trump at his word that this is permanent 100%, that there is no room for negotiation, how bearish would you be on the names of auto manufacturers?
Look, I mean, if this held and it wasn't in pencil and it was in pen, and it actually got enacted, it would be an Armageddon like, I think tariff, for the auto industry. Others could sort of would be less exposed. But Lisa, my whole point is that it would take 3 to 4 years to build a new factory. So the reality is, in terms of this and actually how U.S. car companies make parts, it's just, I view it as untenable. And that's sort of the street reaction. You see more exposed to GM, Ford, a little on Tesla. I think investors are looking at this being like, look, the supply chain basically almost makes this impossible to actually get some of these parts, even from U.S.-built parts, because there's no factories.
Which is the reason why I keep going back to this is permanent, 100%. In response to someone asking President Trump, is there room to negotiate? Where is there room to negotiate on the edges based on the rhetoric that you've heard?
Look, and I think that continues to be the uncertainty. I think maybe the overall market reaction is, okay, there still needs to be some sort of negotiation because the reality is, okay, build it in the U.S., but 50% of parts are from foreign. And sometimes there's parts that you can't even get in the U.S. How do you build a factory? It takes 3 years. So I think that's part of the devil's in the details here. It sounds great, but I think that's why the reality is, especially when it comes to GM, Ford, Stellantis, I mean, there's so many scenarios that they've sort of been, going through, but the reality is this cannot happen overnight. I mean, it would take years. I mean, in our opinion, it would take 3 years to move 10% of the supply chain fully within the U.S., within the auto industry.
Dan, that word negotiation, let's breathe some life into that. Negotiation between who? There was this interesting moment in the briefing when the president was asked about Tesla and Elon Musk. Had you spoken to him? And the president said, no, I hadn't. That would be a conflict of interest, which begs the question, who's speaking on behalf of Tesla? Who's doing the negotiating? Who's doing the lobbying of the U.S. government?
And remember, there was that letter that Tesla had that was unsigned. And I think that, look, it adds another complexity for Musk and Tesla. Because with everything we talk about with Doge and all the political blowback and the third rail issue and everything we've seen in Tesla, the reality is when it comes to negotiation or at least having sort of, someone that has a say for Tesla, they're actually at a disadvantage because of Musk in this situation. That's the irony of it all.
You've soured on the story, Dan. Still bullish on the name, but soured on the story. What needs to happen over the next month to turn this around for the stock?
I mean, Musk needs to take a step back. I thought last week was a huge step in the right direction in terms of the all-hands meeting. But we've talked about arm's length in terms of when it comes to Doge. You need to balance in terms of being CEO of Tesla and Doge because, it's a moment of truth from Musk and Tesla. And this is a political symbol that Tesla's become. It's a third rail issue. And that continues to be our view. It's about balance. Not him getting out of Doge. There needs to be a balance. But last week was a step in the right direction. Now we need to see more wood to chop ahead next 4 to 6 weeks.
Tesla's a perfect microcosm of a larger point that we've been wondering, which is, can you put this genie back in the bottle? Once you come out with some of these tariffs, are the ramifications in other countries, the retaliations going to get a bit ahead of themselves, get out of control? And I wonder what you're hearing as you travel around the world and talk with CEOs and investors about how much this has permanently affected people's opinion toward certain U.S. companies and their willingness to give the benefit of the doubt to the U.S. tech sector.
Yeah, look, and I think part of the problem is if you're actually looking at supply chain, let's just talk about the reality, right? If you're looking at changes in the supply chain, 9, 12, 18 months ahead, you have to start that now. So part of the problem is you can't just start and stop it. So I do think this, and I've seen it, across Asia over the last, call it a month. I saw it in Europe the last 6 weeks. I've seen Detroit. I mean, this is it's caused chaos. But the reality is the enactment of it is almost impossible. Because, and it comes down to, if you have no parts in the U.S., how could you now go into the U.S.? It will take 3 years to build a factory. So the average car will go up 10,000, 12,000. Some could be lower, but that's the reality, is the consumer.
Hey, Dan, appreciate the update. Dan Ives there of Wedbush on the latest in the auto sector. Lynam of BlackRock with us now for more. Not a picture Amanda wants to see. Amanda, good morning. It's good to see you.
Thank you for having me.
What do you make of this difference between Chairman Powell and what you've heard from the officials over the last week? Is there some daylight between the two groups?
Well, I think it absolutely underscores the uncertainty. And going back to the point you were raising, the disconnect between the sentiment data and the hard data, I think part of it is the growth backdrop is much weaker now versus a few years ago. Real wages for consumers have declined, so their purchasing power has declined. The labor market is not as tight. And so I think that's actually what's manifesting, because I agree with you. One of the questions we get is, how could consumer sentiment be so bad? But actually, if you look at the labor market, purchasing power, I think it helps explain that. We see room for the hard data to catch down to the softer sentiment data, and we also see room for credit fundamentals to catch down to what has been a pretty negative revision or earnings estimate and company guidance. And I think it underscores the uncertainty. I don't think we have conviction on the path of policy in many respects, and so it makes it difficult to have conviction on inflation.
It seemed like last week, just to build on the point that John was making, it seemed like last week people heard Fed Chair Jay Powell essentially lean into the idea that they would prioritize any kind of downshifting growth over any increase in inflation. Do you think that that was an incorrect interpretation, or do you think that maybe that is his opinion and isn't the mainstream of the Federal Reserve?
I think during the press conference, it was couched with a lot of uncertainty. He did say, we're not quite sure if we'll be able to look through this. I agree with you. What was actually striking to me was Atlanta Fed President Raphael Bostic's interview with Mike earlier this week, where he talked about companies are actually planning on raising prices, and they're not expecting a hit to their sales volumes. And so it remains to be seen how the consumers will deal with that. But I think there are some inflationary pressures in the system, and I think a lot of Fed officials are telling you that they want to watch that very closely.
There's a larger point here, and we keep coming back to it, this idea of, have people had the idea of a Fed put that is now obsolete in a very different environment? The idea that if growth slows, the Fed can engage with some sort of stimulus by cutting rates. Is that fundamentally being challenged at a time where people are raising their inflation forecasts and lowering their growth forecasts?
I think the reaction function is constrained, is the way that I would phrase it. And I think they really do need to see deterioration in labor demand and the labor market before they actually further normalize policy, never mind ease policy. And so I think that's really the delicate balance that we're in right now, is that they are attuned to downside risks and growth, but I think they are hesitant. And I think even President Bostic said this. They didn't actually want to get ahead of it until the growth data actually materialized. That's the risk. And again, I think it's hard to discount the wide range of sentiment data that has come through. You had referenced the CEO and CFO surveys. The real risk is that if the C-suite starts behaving like there is going to be a significant downturn in growth, whether that's CapEx or investment, hiring, and almost becomes a self-fulfilling prophecy that the sentiment is so bad, so it paralyzes folks, whether those are consumers or corporates, and you actually have the material growth slowdown that we're hoping to avoid.
And then these Thursday mornings start to sound a lot different when we get jobless claims at 8:30 Eastern time. You said catch down. Let's build on the catch down, not just the hard data down to soft, but also the catch down in credit as well. High yield spreads are still pretty tight, around 300 basis points. What degree of catch down are you and the team looking for?
So I agree with you. Credit valuations have not kept track with either the deterioration in sentiment in the equity market or just more broadly. So we think there's some room to widen there. The median is 460, right? So should we argue that there's more uncertainty in this current environment relative to the median of the post-financial crisis era? I think absolutely. Now, to be clear, there are some important counteracting forces that would keep that widening from being that extreme. The technicals are still incredibly strong. Most investors that we talk to are waiting to buy the dip and buy the widening. So to me, that says that most widening episodes may be short-lived. The new issue technicals are really favorable. Not a lot of new money. Most of it's refinancing. So there are some really important nuanced technical factors that will kind of act as a bit of a mitigating factor on widening, but we are absolutely expecting for some widening to come through.
Do those technical factors reduce the volume of the canary in the coal mine?
Well, I think market structure shifts do alongside those technical factors. And so typically corporate credit is a very growth-sensitive asset class, and it should respond more swiftly to growth deterioration. We've had the growth of the private credit market, which on net we think is a positive for funding access because private credit has shown an ability and willingness to step in periods of market volatility. Importantly, something that's not discussed a lot, for example, the CLO market, very rating sensitive buyer, and it comprises almost 2/3 of purchases in the leveraged loan market. They can't hold a lot of CCCs, and sometimes they shy away from B- even when growth is choppy. So there are technical reasons like that sometimes prevent the syndicated market from operating as you would expect. That opens a door for areas like private credit to step in. It doesn't mean that that's bad risk. It just means that the technicals are not cooperating. And so that is new this cycle.
To build on what John's asking, are we looking in the canary in the wrong place? That the idea of high yield spreads traditionally as a leading indicator for risk assets has no longer the same kind of telltale effect, and that really it's private markets that we need to be looking at. Are we seeing signs of stress in private markets in any capacity?
You aren't really seeing a large degree of stress in private markets either. I think what that means is that the nature of the shock is not emanating from the credit market, whether that's liquid or private credit. It's actually emanating from consumer spending, policy uncertainty in some regards. And so I think that's probably the difference in this environment, is that if the nature were coming from the credit market, if it were over-levered companies that were doing shareholder-friendly actions, doing M&A and levering themselves up, perhaps that would be the early signal from the credit market, but that's actually not what's happening here. It's the nature of the stress is not coming from the corporate market. It's coming from uncertainty and a potential slowdown in consumer spending.
Do you get the sense this market won't really take these headlines seriously until we see it in the hard data?
I think we are seeing signs of it being taken seriously. So, for example, we're seeing certain sectors underperform, even though index-level credit spreads are tight, as you noted. We are seeing some underperformance. I would say on the margin, investors realize that the administration is focused on raising revenue, and so tariffs are a means to do that. And so, again, we don't dismiss the sentiment data, nor the potential for significant policy shifts. Our colleagues in the BlackRock Investment Institute expect an average effective tariff rate of 10%, which is well above where we are now.
Amanda, appreciate your time as always. It's good to see you. Fantastic. Amanda Lynam there of BlackRock.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.